Hey everyone, welcome back to Beckles Fin Talks. Today's Friday, May 15th. Trump just finished his China visit and left, and right after that, global markets tanked. A mix of macro and money flow issues sparked wild swings. The 10-year U.S. Treasury yield shot past the key 4.5% mark today, setting off alarm bells for risky assets worldwide. Things are heating up again in the Middle East. According to Iran's Tehran Times, the U.S. rejected Iran's 14-point peace proposal and said patience is running out. Meanwhile, Israel revealed it's getting ready to restart military actions against Iran, which could last days or even weeks. Now everyone's waiting on Trump's final call. The geopolitical tensions are ramping up inflation worries, totally crushing hopes for any rate cuts. Bond yields everywhere are rising, and traders are basically ruling out the Fed cutting rates this year. Some are even betting on hikes. Plus, today's the third Friday of May, meaning option settlements are happening. Recently, there's been a lot of gamma squeeze action with everyone blindly buying call options. But on settlement day, with the 10-year yield breaking 4.5%, it was like a starting gun firing a wave of profit-taking. U.S. stocks held up pretty well through this storm, with the big three indexes only down a little. But South Korea's market wasn't so lucky. It hit a circuit breaker and plunged hard. People say Chinese investors love to gamble, but I think Koreans might take the cake. It's like the whole country was playing a giant options game. Today's market recap: the Kospi futures crashed 6%, triggering a circuit breaker, and the two heavy hitters, Samsung and SK Hynix, took a big hit. The global semiconductor sector has been dragged down hard. Nowadays, AI-related industries, including semiconductors, data centers, and power infrastructure, make up more than half of the S&P 500's weight. Because of that, the U.S. stock market is now fully caught up in the ups and downs of the AI craze. Today, the hottest AI stocks and semiconductor sectors all pulled back across the board. Space, industrial machinery, and automotive sectors also dropped sharply under inflation pressure. Most sectors looked weak overall. Amid all the red, the software sector bucked the trend and surged, causing a massive short squeeze party. The software sector's potential short squeeze risk indicator had hit 100%, the max level. With money rotating around, there was a precise, targeted breakout. This mixed scene of gains and losses shows that big players aren't panicking and fleeing the market blindly. They're still actively rotating their positions, but that doesn't mean they're still bullish. They just need time to adjust their holdings. Right now, both bulls and bears are testing each other's limits. Bulls can't fully leave yet. They're selling off AI semiconductor stocks that have run up too much and are overcrowded, while looking for a last safe haven in software stocks that haven't fallen much. Bears are watching inflation data and the new Fed chair's policy signals closely. The S&P 500 dropped from a high near 7,500 points today, closing below the 5-day moving average, but holding above the 10-day moving average. QQQ showed a similar daily pattern. Although this pulse-like rally can't continue forever, the bulls have shown strong resistance. After today's dip testing the uptrend line, the market was pulled back up again. The bulls have held on to their strong position for now, but the market's at a really fragile tipping point. The divergence between the Nasdaq 100 and the inverse indicator of the 10-year Treasury yield has reached a dangerous level. The Philadelphia Semiconductor Index dropped 4% today. Bank of America analysts quickly came out after the fact, saying semiconductor prices are currently 62% above their 200-day moving average, which is way too high and needs to snap back to the mean. Back when prices were soaring, no one cared about these deviations. Now that they're falling, everyone acts like they just discovered the problem. The triple-leveraged semiconductor ETF Soxal plunged nearly 12% today, but compared to its low in early April, it's still up about 3x, so profits are still pretty solid. Looking ahead, considering the seasonal patterns in the U.S. stock market, mid to late May is usually a turning point that brings some temporary weakness, more volatility, and pullbacks. On top of that, every time the Fed gets a new leader, the market tends to have a short-term dip. Even when Yellen took over back then, the market still pulled back within the year. The current market environment is way tougher than previous leadership changes. So, although QQQ is still holding above its uptrend line for now, with FOMO fading and the market becoming more rational, breaking below that trend line is probably just a matter of days. The real turnaround might not come until June. Latest news says SpaceX will set its IPO price as soon as June 11th, with shares going public on June 12th. Before such a giant IPO, the big players will definitely want to keep the overall market steady and protected. So, after QQQ dipped below this trend line during a short-term pullback, it's likely to enter a sideways trading phase, waiting for SpaceX's IPO to boost things. The simultaneous rise in U.S. Treasury yields and the dollar further pressured precious metals prices. Spot gold dropped. High interest rates are naturally bad news for gold. Holding gold, which doesn't pay interest, becomes more costly in this environment, and priced in dollars, gold gets even more expensive for overseas buyers. Gold pretty much had to take a hit. Spot gold's drop was its biggest single-day decline since February 12th. A few days ago, silver got a boost from crazy speculative money flowing into industrial metals needed for AI data centers' power, wiring, and cooling, plus fuel supply issues in Peru, a major producer. But today, with the hype fading, silver prices fell sharply back near the 6-month moving average, a key support level that's held up for the past 2 months. Now it's a question of whether it can hold. Today, Trump's investment holding is also raised by the media. It was been behind the scenes in the stock market. According to the latest financial disclosure documents from NBC and the U.S. Office of Government Ethics, Trump made a staggering 3,642 stock trades in Q1 2026. That's around 60 trades every trading day, even more active than many quant funds. The filings show his portfolio shifted aggressively away from a conservative, bond-heavy allocation earlier in 2026 toward a much more aggressive stock-focused strategy involving major U.S. companies. The total value of these trades ranges between $220 million and $750 million. Looking closely at his rebalancing list, big purchases between $1 million and $5 million include S&P 500 index funds, Nvidia, and Apple. The big sales, ranging from $5 million to $25 million per trade, mostly involved investments in Microsoft, Amazon, and Meta. These were the hottest picks in their carefully chosen portfolios. Semiconductor companies like AMD, Broadcom, and others aligned perfectly with the White House's push to boost chip production. They also bought financial stocks like JP Chase, Goldman Sachs, and Visa, matching the U.S. government's plan to ease financial regulations by 2026. They went all in on Coinbase, Robinhood, and SoFi right when the White House was rolling out crypto-friendly policies and setting up a federal Bitcoin reserve. Even more interesting, the government's new Trump account retirement plan initially had Robinhood as its trustee. The most controversial move was with Dell Technologies. Since February 10th, Trump's portfolio kept buying Dell shares in 7-figure amounts. By May 8th, Trump publicly praised Dell at the White House, and Dell's stock price shot up 12% that day, making Trump's position skyrocket in value. Critics raised concerns about conflicts of interest, but this all fits within what you might call the White House stock playbook. Honestly, everyone already knows this is just the surface. As for other stocks, design software company Figma saw its stock jump over 13% after reporting earnings. The company's Q1 revenue grew 46% year-over-year, beating market expectations and marking the second consecutive quarter of accelerating revenue growth. However, due to AI-related investments and higher employee costs, gross margins dropped from 91% to 79%. This caused the quarter to swing from profit to a net loss of $142 million. Adjusted earnings per share came in at 10 cents, beating the expected 6 cents. The company also raised its full-year revenue guidance. After the earnings release, Wall Street analysts praised the strong paid conversion of Figma's AI features, but simultaneously lowered their price targets for the stock. Today's big jump was mainly driven by short covering. So, despite strong short-term upside potential based on the company's outlook, Microsoft's liquidity today also pushed a solid 3% short-term gain. Bill Ackman backed Microsoft, saying the market worries are overblown. He announced that since February, Pershing Square has been building a position in Microsoft, and it has now completed a new core stake in the company. Microsoft stock is down 12.5% year-to-date. There are still big concerns about how quickly its AI assistant, Copilot, will be adopted and whether its core 365 business, including Word, Excel, etc., can hold off competition. Additionally, Microsoft faces bottlenecks in expanding its data center capacity. It's hard to fully meet the rapid growth demands of cloud services. Although I think the market's worries about Microsoft are really just an excuse to drive the stock price down, the fundamentals are actually solid. They have diversified businesses, strong cloud growth, loyal enterprise customers, and a very deep moat. But as for Bill Ackman's approach, I just want to roll my eyes. It's obvious he's been accumulating shares and now he's pushing us to buy in, waiting for us to boost the price for him. Today's big price jump is partly because Bill Ackman is bullish, but more importantly, it's about money switching from other sectors into software stocks. So, next 2 weeks, a better strategy is just to watching the market a bit, not to rush in. Wait to see how our new head of Federal Reserve would tailor the policy. Okay, enough for today.
See you next time.
If you liked the video, please like, subscribe, and hit the bell so you don't miss our future videos.